What this is all about people with subprime credit and also people new to credit. So it's kind of a second chance, if you will. So starting the middle of next year, for people that are denied credit, FICO is going to give them the opportunity to have a second cut. And they're going to look at their bank accounts, and they're going to see, have you had the bank account for a long time? Have you overdrafted? Other things like that that might give people the ability to raise their score up to 20 points and maybe get into a loan that they otherwise would not have qualified for.
That stuff is not already taken into account at all?
No, bank accounts don't account at all in the credit scoring system right now. So this is a little bit of a slippery slope. The thing that I'm worried about from a consumer standpoint is this is the best case right now. The economy's doing unbelievably well, unemployment's low, credit delinquencies are low, GDP is really high. What happens in a few years if we do hit a recession? Are people going to get into loans now that are going to be hard to repay in the future?
Don't banks take this into consideration? I mean, mortgage lenders or anybody looking to extend a loan, that they'll take a broader look, or do they simply just look at that FICO score and that's that?
It depends. You know, I think for a mortgage, they are going to take a wider scope. And I think mortgages are an interesting tie-in here because so many people that could have refinanced already did. So I think these FICO changes are really the lenders and the industry saying, let's broaden out a little bit. We want a larger scope of people to lend to. And a lot of people who refinanced or could have refinanced already did. So now they're trying to open up to more of the subprime.
Sounds like a way to juice up applicants at a time when applicants are going down because people don't want to borrow at higher rates.
And that's what's worrisome about it.
Right.
The fact that people might get into bad loans now. And also, it's a slippery slope. Historically, how much money you have is not part of your FICO score. It's how you manage your money, not how much you have. So looking at bank accounts, you know, let's say down the road, people with more money are viewed as more creditworthy. That kind of defeats that whole access to all principle that I think is really inherent in credit.
So in other words, is this going to be sort of the court of appeal? In other words, you get one credit score, and if you don't succeed, you go back and you appeal, and they run a second sort of screen and look at your banking history?
That's right. Yeah, FICO says that there are about 4 million people whose scores could go up about 20 points based on this model. They say about 7 in 10 people who fall under this category will be approved that wouldn't have otherwise.
7 in 10 of people who wouldn't have gotten approval, when they go back for this second cut, will get approved?
That's what they're saying. And I think that's fine for people that are new to credit. Like, for example, I have a brother in his mid-20s. He had trouble getting his first credit card because
he didn't have
credit.
Yeah.
He rented an apartment, but that didn't count. He had a cell phone. That didn't count. Utilities. You know, I'd like to see those things addressed. I think some of these requirements, though, might be going a little too far.
It sounds like loosening lending standards in a different way, in a more formalized way.
I think that's exactly right. And I think that's sort of the buyer beware. I think consumers need to realize that just because they can get one of these loans doesn't mean they should. Don't qualify only under the best case scenario. Think about, you know, what if my income went down a little bit? Or what if, you know, interest rates continue to go up? Credit card rates are 17% now. They could well be 18% a year from now.
Their borrowing rate also, I would assume, would be much higher using an ultra FICO.
That's right. Yeah, we see on the high end, credit card rates average about 25%. On the low end, they average about 17%.
So if you go through and submit the ultra FICO, the super, they may charge you more. They're going to know than you would if you just went through on the first cut.
That's definitely possible. Yeah, the worse credit score, the higher the interest rate. So really important for consumers to pay those balances in full. I mean, you don't want to be paying 17, 25% just to get some rewards. Rewards are great, but you got to pay those bills in full.